welcome to our mortgages webinar with John Doan. I'm really excited about this because I know in talking to hundreds of freelancers, this is a huge problem. Obtaining a mortgage is a huge problem for a lot of our community. I know I've experienced it firsthand, and so I'm really excited to have him here today. Just some brief housekeeping. We do have a recording that will be available after this. It'll live in the Numina platform in the Mortgages Noom. So make sure to go there if you are looking for this recording. And there's also a lot of other resources around obtaining a mortgage that you'll find there. So without any further ado, I will introduce John Doan. John, welcome.
Hi, thank you for having me today, everybody. Good morning.
We are so excited. So can you tell us a little bit about who you are and what you do?
Yeah, sure I can. Hi, everybody. I'm John Doan, president here at Equinox Home Financing. Been in the business now a little over 20 years. And so I've seen the ups, the downs, all the different types of loan programs that have come and gone and that are still here. And today with my company, we specialize in alternative loan programs. Now we offer traditional loans, which is our bread and butter, but our specialty is in really niche alternative loan programs. And I'll give you a little backstory on that. So in 2013, when I was trying to buy a home, I couldn't get qualified. My 1040s or my tax returns, after all the write-offs that the IRS allowed me to deduct, showed very low or no income.
Yeah.
That wasn't doing anything crazy. We're all allowed to deduct certain items. And if you follow just that alone, your tax returns won't look so good.
Sure.
So I made it a point to go out. I said, I want to buy a home, for my family. Let me go seek what programs are out there. They're not like hard money or, Louis the leg breaker type loans, right?
Yes.
That's not what I wanted. So I really made it a point to go out and find these products or programs that were available. And I mean, by 2014, we've been specializing in that, so
I love that.
Yeah.
Could you talk a little bit about the state of, the mortgage industry, the economy, and some of your thoughts on that?
I sure can. So I get this question multiple times a day. So
Yes.
I'm pretty good at answering this question right now. The industry was pretty stable in 2019. It was doing good. It was normal. People were buying, and a lot of that was because, since 2013 or 14 even, we had an inventory issue, right, in America. Just the problem that we've been having is that there just hasn't been enough homes for sale. Not enough brand new homes for sale, that is, which keeps the cycle kind of going, right? So, since 2013, when I finally found a loan program for myself, even I was bidding against 5 or 6 other people, nothing crazy, but 5 or 6 people is still a good amount of people to be bidding against when trying to buy a home. With that said, 2019, things were really humming, and then boom, 2020, COVID hits. Everyone in our industry thought it was like the end of the world. I mean, all programs in March, I think March 24th or whatnot, all programs got suspended. Nothing was closing. It was just at a, standstill for like a week or two. And then something happened, right? Rates dropped to historic lows that we had never seen in history. And so with that said, that gave birth to 30-year fixed rates at like 3%.
Wow.
And, even as low as they were fluctuating up and down, to as low as like 1.9% on a 15-year mortgage.
Wow.
Just ridiculous, right? So what did it cause? A huge boom. Because home affordability was so, high, meaning the payments were so low that so many people could finance properties, it just caused what I like to call a mania, right? Everybody was out. We're all at home. We're stuck during the shutdown. And what are people doing? They're at home and they're like, oh, wow, this house is a lot smaller or tighter than I thought, or there's just not enough space. And then, everyone's at home looking at homes for sale. And with these really low rates, why not go out and buy? So, in 2013, when I was buying, it was like 5, 6 bidders. We're talking about, I mean, in some areas, 25 bidders, 30. I mean, it was a mania, right? So a lot of people were just overbidding each other to the point where people started paying more than what the value of the home was worth. As a matter of fact, I did several. I mean, just in my local area here, even I remember doing one deal where there was like 25 bidders on the property. Very nice. Yeah, it was over 25. And, they went with the highest offer, which happened to be one of my buyers or my clients. The home appraised for $1 million, but it closed at $1.3 million. They paid $300,000 over the appraised value. Okay.
Wow.
Now, that wasn't common, but I'll tell you what was common across the nation. We're licensed in 15 states. And it was like, I would see a minimum of $50,000 over appraised values being paid for, right? At least. And what was common was like $80,000 to $100,000. And, so this caused home prices to appreciate rapidly, right? I mean, think about it. If everyone's overpaying for homes and you got the whole nation overpaying for homes now, surely home values have no other direction to go other than up, right? Sure. And so home prices were rising, and as people are getting excited and the mania is just, getting out of control, it's going up and up and up and up. So that happened all pretty much for 7-8 months out of 2020, all of 2021. And I would say like the first 3 to 4 months of 2022 until the Feds raised rates because news of inflation had been released. And so rates started popping back up and it started slowing. So since June of 2022, we've definitely seen a decline. If any of you are watching the news, I'm sure you've seen it, but home sales are down, mortgage rates are up. Mortgage rates today are even higher than they were in like 2012 or 13 when they were peaking. So yeah, the rates, are definitely higher right now, making affordability harder. However, the point that I'd like to make, or that I talk to everybody on, is this: if you were a buyer looking to buy in 2020, 21, or 22, and you were overpaying for a home, one thing about that everyone needs to realize is once you overpay for a home and you spent money out of pocket to pay for a home that's like cash out of pocket more than it's worth, guess what? You're not recovering that money. I mean, you will at some point because real estate always goes up, but you've just spent a bunch of cash that you won't recover, even though the rates are really low, right? So your payment may be low and the rate is low, making it affordable. However, in today's market, I'll tell you what is happening today, right now. Home prices have normalized, and people are always asking, John, are home, prices going down? And, it's like with home prices, it's not always either up or down. How about just flatlined or standard, right? Or having them normalize. So with that said, right now it's just normalizing, right? Home prices are selling for what they are worth. They're not selling for below the appraised values. They're all kind of coming in at where they're supposed to be right now, And so with that said, okay, let's say rates are higher, which means your payment is higher. If you do the math, okay, compared to buying a home a couple of years ago, even with the higher rates and payments, it would take you years, okay, to overpay by $50,000 to $100,000. Do you know what I mean? So overpaying for a home a couple years ago, but having a low payment is one thing. But now you have an opportunity to buy a home at the standard or normalized price, and your payment will be higher. But the variable that you have in control here is that when, not if, but when interest rates drop again, you get to refinance your mortgage into a lower interest rate, therefore bringing your payment back down, but not overpaying for the property. So it still makes a lot of sense to buy right now, in my opinion, regardless of what the news says or whatnot. It's just all perspective of how you see it.
Yeah, that makes a lot of sense. That makes a lot of sense. So John, I know that, you have a niche working with people like those that are in our community, people that have unpredictable incomes. They are freelancers or entrepreneurs, like you said, may be taking a lot of tax deductions. Can you tell me a little bit about some of the programs that you have for people like that?
Yeah, so we have several programs. I'll talk about the three main ones that we do the most volume in. Okay. So the first program that's for, entrepreneurs. This is the program I went with when I bought my house. This is the first one that came out, but it's called the bank statement program. And so if you're an entrepreneur, you're self-employed, you're a sole proprietor, you are independent contractor, you're a side hustler, or whatever it is, and you have multiple streams of income, like a lot of people do these days, what we do, instead of looking at paycheck stubs or instead of looking at, tax returns, we simply look at bank statements. We're looking at what you deposit into your bank account on a monthly basis, and either we'll collect 12 months or 24 months, whichever one is stronger, and we'll do an average of what your average deposits are. Now, on this program, I want to be very clear. We are looking for revenue, okay? So if you have a bank account and you're a day trader and you're, selling off stocks and depositing it into your account, unfortunately, that doesn't count. Okay, we are looking for revenue, business revenue, to be clear. And so, a lot of people have a good amount of revenue. And so in that particular program, whatever, the average deposits are, we will take a percentage and say, okay, this is how much you generate, but you need to run your business with expenses. So we'll say that 20% of those deposits are to go and run your business, which is an expense factor, but 80% you take home. So now all of a sudden you've got income on paper in order to buy a home. Okay. That's so awesome. On that program there, it starts at 10% down. So, traditional loans, conventional, right? There's like 5% and then there's 10% down. This one right here, because of the risk that's involved with, the alternative way to document your income, 10% is the minimum down payment. And with 10%, you need like a 720 credit score and above in order to qualify for the 10%. However, if you have 15% or 20% down, it gets a lot more lax. We can go as low as a 620 credit score with a larger down payment, for example.
Wow.
Yeah.
That's awesome.
Yeah. So that would be our, most popular program. The second one is straight up. It's a government-backed program that was created during the Obama administration for those that have assets but cannot prove their income. So, on this program here, it's just a no income program, period. We don't verify any income. We don't look for income. We don't look for anything at all. All we're looking for is, do you have the assets to be able to buy a property, and maintain those payments by looking at, payment reserves. So for example, on this program here, if you have a 700 or 720 credit score, let's say 660 is the minimum, by the way, but let's say you're at around 700, the program requires at least 20% down, if not 25% down. So there's a lot of skin in the game, right? Like you have to have money to put down, but that's your commitment that you are serious. And that if, you ran into a tough situation, you wouldn't just get up and leave, right? But on top of that down payment, we have to see that you have an additional 12 months, 1 year of mortgage payments in the bank to show, but not to spend. So if you buy a home with a mortgage payment of, let's just say, I don't know, $5,000 a month, we want to see that there's 12 months of payments in savings, in stocks, and retirement, whatever vehicle it is, doesn't really matter. But we want to see that you have about 60,000 in it so that you can cover the next year's worth of mortgage payments. If you, as an entrepreneur or somebody that we are not proving income for, can handle those payments for at least that long until you figure things out.
Wow. That makes sense.
Yeah, it's a super popular program. That program is made for primary residences and vacation homes. So you can use it on either. Yeah. Yeah, you just can't use it on a investment or rental property. Now, I did say that that was a government-based program. So one thing you do have to do is, in order to complete the loan, you do have to take a 1-hour online course that's designated by, an official counselor to learn about, mortgages and finances. So they do make you get certified, and it's a 1-hour course because that's what the government requires in order for this program to work. So that's the no income loan program, and we do a ton of those.
Wow.
The third one would be our rental property program that does not require credit scores, and I'm sorry, it doesn't require income documents. It does require good credit scores. But if you're looking to buy an investment home to add to your portfolio, if you're looking to do Airbnb, which we specialize in, by the way, folks, a lot of people don't know this, but Airbnb is killing it.
Wow.
And so, we're promoting it a ton. Investment property loans, even with traditional loans or, conventional loans, the rates are much higher than they were. However, if you're going to specifically buy an investment property to do a short-term rental, whether it's Airbnb or Verbo or whatever other options are out there, right? It's just making so much more money than a long-term rental is, So, for example, I just closed on a property. This is in Surfside City in Houston, like in the Houston, Texas area. And a year ago, actually it was a year ago, sorry, I just closed it. The anniversary is like last week, and it's been a year. But, they bought a property along the beach, along the ocean. It was about $380,000. That home would have rented like annually at $2,500 a month at that time.
Wow.
But, I told my buyer that I've been working with for quite some time that, hey, you should buy this and just leave it as an Airbnb. And guess what? You get to use it whenever you want to, whenever it's not booked. You get to use it yourself as if it was your own home. But all the other days that you're not, you can do short-term rentals. He's very, very skeptical. He's like, I feel safer at $30K a year, but it's guaranteed in rental income. I said, just take a leap. So it's been exactly a year, and he has brought in $78,000 gross.
Wow.
So it's more than double. I can't say that that's going to happen everywhere. It really depends where the location is, but there's no way that property would have rented out for $6,000 per month long term. So even though these stated income programs or no income programs for investment properties, they have higher interest rates, it doesn't really matter because the cash flow on these short-term rentals, it's so high that it covers and it's profitable.
Wow.
So, these are the three main programs that we are offering right now, that we're just doing a lot of. So, and it fits the Numina model quite a bit with the entrepreneurs that we are working with and, the members that we have.
Awesome. It's such a great resource. And I know that it's such a big problem for people in our community. It's one of the number one problems that we hear when people talking to people, even people who are very, very successful and have been doing this for years. It doesn't matter where you are on the growth of your business. Everybody deals with it. Yeah. John, I have a few questions that came in from members. Could I shoot some of those at you and go through some of the questions?
How fun. Yes, let's do it.
Okay. So is there a specific credit score that you're looking for when approving somebody for a mortgage?
Yeah, and it's just really program specific. So let's say it's like the bank statement program. I have one program. If you have 35% down payment using bank statements, I have a program that goes as low as a 600 credit score, for example. On the no income program, where we don't need any income documentation at all, but you're putting a larger down payment, that one has a 660 minimum credit score. On the short-term rental program, for example, that one does require also a 660 minimum credit score typically.
Okay.
And I want to touch on this, okay? If you have a low credit score, I've been doing this a long time. We have somebody in-house that does nothing but works with our potential buyers, or clients on how we can get their credit scores optimized.
Wow.
Okay. So we have all these systems in place, software. Once we run a credit report, we have what's called a what if simulator with all three credit bureaus. And what that means is we get to go in and simulate. And some of you might be familiar with this with, some of the apps that you have. but except this is way more accurate than like the Credit Karma ones or whatnot.
Sure.
So we go in and we can delete accounts or pay credit cards off, or, simulate what it would be if a collection, falls off in 3 months, right? And is removed from your credit report. We have visibility to all of this information, therefore being able to prepare you, to get you to buy with better terms. Because at the end of the day, if you meet the minimum requirements, the only other thing that higher credit scores would help you with is better terms, better rates, maybe less down payment, and, honestly, if you have an underwriter that's working on your loan, someone with a 700 credit score might have an easier underwriting than someone with a 620, right?
Sure.
So in that case there, I just wanted to share that if you do have a lower credit score, let us help you with that. We help people with their credit on a daily basis. Sometimes it's just really simple stuff.
Yeah.
I had somebody who, we pulled a credit report on that has 600 credit score last week. After digging into it and making a few calls on the phone, we did it together, just conference called the creditors, found out that it was not even his. It was like a family member's that had a similar name. We sent in some proof. They sent us a letter that they were removing it off his credit. Because we're buying a home, I sent that letter into all the 3 credit bureaus. It's an expedited rush fee where they remove it off your credit immediately, but his credit bounced up like 110 points on average.
Oh my
just
goodness.
because it was a large collection account that did not belong to him.
Wow.
So,
That's awesome.
once we removed it, it jumped up a lot. But, what I'm saying is, sometimes there are errors that we can help remove, as simple as that. And sometimes they're not, it may be complicated, but we can definitely dive in and take a look to help with that, in other words.
That's awesome. What an incredible resource. So that kind of leads into the next question that we got is, when should somebody start preparing, contact someone like yourself and really think about, the logistics of actually buying a home and getting it financed?
Yep, got it. So, at the end of the day, there's a lot of not pain points, but there are a lot of points in someone's life when they are ready to buy, right? So number one, I would say the most common reason why is, they're renting, and rent's gone up year after year. And now it's like so high in certain areas. People are like, why am I even renting? Why am I paying someone else's mortgage for them when I can go and buy on my own? So if that's you, then you need to, stop and think, do you have enough money saved up? And if you do, and if the answer is yes, after you spend that money on a down payment and closing costs, do you still have reserves so that your life is comfortable and that you're just not, making these mortgage payments, but don't have any money left over for reserves or emergencies? And, so that's just the cash portion of it. The second part is, how's your income? Has it been stable? Are you comfortable? If you got into a mortgage that was at your rent price or maybe even higher, would that change your lifestyle? And if it's not going to change your lifestyle and you are making good money now as an entrepreneur, then it sounds like you probably do need to buy a home, because there are other advantages. One of the biggest advantages is when you rent, you don't have any write-offs for tax purposes. But once you buy a home, now you get mortgage, interest deductions, property tax expense deductions, and there are just other deductions that you can take now, versus not having those deductions, being a renter, right? So those are some of the things that you should think about. But if, you feel comfortable about that, that's when you should contact, us so that we can get you qualified, and walk you through the process. We deal with, 80% of our clients are first-time home buyers.
Wow.
So we're very, very good at making sure, people that we work with have a great experience. Because when, the biggest complaint that we hear with first-time buyers is like, hey, I called this bank or I called this lender, they were on TV, but they really were just like pushing us through the process instead of like breaking things down and helping us understand how this works, because we've never done this. And so I feel like our team is really, really good at that. And with that said, I get a lot of people that I speak to, once or twice, they don't go through the process. And it's like, boom, 2 weeks later, John, guess what? I'm in contract for a home. But I'm like, hey, I never took your application or ran your credit or even looked at your bank statements, So a lot of people like will just go out and, start looking at homes and negotiate on contracts without even getting pre-approved. And I don't recommend that,
Wow.
because you're getting excited and you might be let down, or, there's a lot of pressure there,
Sure.
and deadlines involved in order to fulfill your commitment at that point.
Yeah.
So, always get qualified first if you're interested. If you're afraid of getting hard inquiries on your credit report, we also do soft inquiries too, if you are worried about that, and we'll run the hard one when we're ready to go into contract. But yeah, I mean, it's pretty painless. You fill out an online application, we get that back, you submit your bank statements so we can look at your income, and then we'll get you qualified and see what we need to do. So either A, we'll qualify you and you're ready to go, or we put together a simple plan, whether short or long-term, of how to get you ready to buy,
I love that. I love that. Well, John, thank you so much for coming on and talking about this today. Again, I know that what you're offering is such a resource for our members, and you can find John and find information on the mortgage programs that he offers inside the Numina app. We have a section under the money tab, and then we also have a Noom all dedicated to mortgages. So feel free to reach out if you have any questions, but thanks again, John. We really appreciate you.
Thanks, everybody. Have a great day, and thanks for having me on. Have a good one.
Thank
you,
you.
John.
Bye now.
Bye-bye.